Welcome to Dividend Income. Michael Burry has been warning everyone that the stock market is due for a huge crash. He likes to bet big and has a great track record of getting the timing right. He predicted the 2008 crash betting big against the big banks. Based on his calculations, he knew that the housing market was unsustainable and that a collapse was coming. He and his investors made millions from it. Michael Burry reportedly earning a personal profit of $100 million and his investors $700 million. It also inspired the movie The Big Short. Christian Bale played Michael Burry. I highly recommend watching it. Michael Burry, CEO of Scion Asset Management, has been warning about a market crash for a while, tweeting early last year that we are in a speculative bubble and a huge crash is coming. He now must think the crash is very close, as Scion Asset Management sold almost all of their US stock positions. He filed 13F reports showing that he sold nearly all of their stocks, including Apple, Alphabet and Meta. A 13F report is a quarterly report that is required for all institutional investors that have at least $100 million under their management. Michael Burry has only bought one stock, a stake in a prison company, GEO Group Inc., ticker symbol GEO, acquiring 501,360 shares during the quarter. GEO Group is the world's second largest private prison company. Basically, it makes more money the more people that are behind bars. Feel free to draw your own conclusions why you bought those shares in this. So what are other institutional investors doing? Do they share the same opinion as Michael Burry? Berkshire Hathaway's Warren Buffett has a different view on the market. He has not been selling off, but he has not been investing as much. He has $70 billion to invest and has only spent $4 billion of it. Berkshire Hathaway still have a lot of cash on hand to still invest. Investing the $4 billion was only spent on investments they already have shares in, so they have not seen any new opportunities worth investing in. Now, should you be worried? Michael Burry has said that we are only halfway there with a market crash. Even if that is true, I am not planning on selling anything. I am being cautious, but I am a long-term investor. Having a diversified portfolio always helps. I'm keeping some money aside for any big dips. I'm still buying stocks monthly, but concentrating on the ones that represent the best value. Stocks go up and down, but the dividends keep coming in, especially from the dividend kings. These companies have survived stock market crashes and global pandemics. Some companies actually thrive through recessions and bear markets. Companies that have products that people will buy regardless. Walmart is one such company, a discount retail giant serving around 230 million customers each week. It focuses on everyday low prices and actually thrived through the 2020 pandemic. It has continued to raise its dividend year on year. The dividend yield is low at 1.63%, paying a quarterly dividend of 56 cents a quarter. Its current price is $137.02. TipRanks analysts give it a strong buy rating with a mid-price target of $151.61, so that's a 10.65% upside. Looking back over the last 5 years, it has had a long trend of upward growth. PepsiCo is another one. People always need to eat and drink. The company owns 22 iconic brands such as Pepsi, Gatorade, Tropicana, Lay's and Quaker, which each generate over $1 billion in sales. Its economies of scale allow it to run the business with extremely competitive operating costs. Management's current initiative is designed to cut annual costs by $1 billion over the next few years, which should further boost the company's solid margins. It has been paying dividends since 1965. The dividend yield is 2.55%, paying $1.15 a quarter. TipRanks analysts give it a moderate buy rating. It has an average stock price target of $180.70, so that's only 0.29% upside, which isn't very much, but this is a solid stock. And looking back over the last 5 years, it has had a long trend of upward growth. Johnson & Johnson is another stock I like that shows resilience time after time. Its biggest strength is its diversified business model. They have a long list of consumer staples, products that cover health, beauty and hygiene. The behemoth is a money printing machine. It has been paying dividends since 1972 and have been increasing them year on year. The dividend yield is 2.67%, paying $1.13 a quarter. TipRanks gives it a moderate buy rating, with an average stock price target of $188.73. so 11.47% upside. Looking back over the last 5 years again, it's got a long trend of upward growth. Like Johnson & Johnson, Proctor Gamble is another stock deemed recession proof. It too has a long list of consumer goods, including beauty and grooming supplies, household care items, soap and detergents. It has been paying dividends since 1890. That is 132 years straight. The dividend yield is 2.44%, paying 91 cents a quarter. Tip ranks analysts give it a moderate buy rating, with an average stock price target of $155.08. So that is a 3.57% upside. Again, looking back over the last 5 years, it has had a long trend of upward growth. Other notable mentions: McDonald's Corp, ticker symbol MCD. McDonald's was one of the best performing stocks in 2008 after the financial crisis. Plus it bounced back after the pandemic drop. McDonald's provides food at a low price, and as consumers economize, it benefits. Owning all of the real estate definitely helps, keeping the overheads low and the balance sheet healthy. It has a dividend of 2.07% and a quarterly dividend of $1.38. The stock price has grown steadily over the last 5 years, and it looks like it will continue to go in that direction. McDonald's have a strategy in place to double down on the 3 Ds. The 3 Ds they are referring to is digital, delivery and drive-through. Enhancing their digital platform experience from customers to engage more with mobile ordering, delivery, payments and rewards. They want to be the global leader in food delivery, continuing their growth in that segment. Also speeding up their drive-through delivery. The quicker customers can order, the more customers they can serve. Another one is Pfizer, ticker symbol PFE. Again, Pfizer performed well in 2008. People still need to look after themselves and keep their health in check. It obviously did well through the pandemic because of the company's involvement in COVID-19 vaccines. It has a dividend of 3.3% and a quarterly dividend of 40 cents. The stock price fluctuated over the last 5 years, but has a general upward trend. The growth should continue as Pfizer have acquired Arena Pharmaceuticals for $6.7 billion. This brings Pfizer a portfolio of diverse and promising development stage therapeutic candidates in gastroenterology, dermatology and cardiology. They have also acquired Reviral Limited. They focus on the treatment of viral infections for around $525 million, plus announcing recently that it would be buying Global Blood Therapeutics for $5.4 billion, boosting Pfizer's rare disease business and helping it aim to add $25 billion in revenue by 2030. These are resilient companies that have been through a lot over the years. I expect to see lots more volatility in the market, days where stocks are down and all those gains are lost. It can feel demoralizing and panic can set in, but as Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful. Markets recover and eventually a bull run will start again. I like to look at it as a stock sale. I plan to keep dollar cost averaging through any turmoil, hopefully bringing down my average buy price, giving me a better yield on those dividend stocks. Thanks for watching. A quick disclaimer now. As always, you should do your own research when investing. I'm not a financial advisor, and these are my personal views. The purpose of this video is to give you additional information and hopefully help in making informed decisions. Thanks for watching. If you enjoyed the video, please like and subscribe.